Well, Blackstone-backed Embassy Office Parks launches India's first real estate investment trust, or REIT. Now, it is likely to be Asia's biggest REIT by size. Earlier today, CNBC-TV18's Kevin Lee caught up with Mike Holland, the CEO of Embassy Office Parks, and began by asking him how much do they plan to raise through this listing. Take a look.
We're raising 4,750 crores. It's a primary offering. The sponsors will retain essentially 70% ownership of the REIT. The proceeds will be used to pay down existing debt levels. Debt today is a reasonable 27-28%. That will come down to a sub 15% level. And the rationale around that is so that we have the horsepower and firepower at a later stage, if necessary, to take on debt for acquisitions.
You have 11 assets as part of this portfolio spread across 33 million square feet, across more projects to this portfolio. If I understand correctly, you have a right of first offer with the Embassy Group as well for about 47 million square feet. Yep. Take us through the future plans.
Yep. So today we have approximately 25 million square feet up, running, operational, 160 corporate occupiers. There's 2 lakh people working on our business parks. It's a really large scale. Then within the camp, million square feet of potential portfolio. Beyond that, the Embassy ROFO assets, so the right of first offer assets, whereby Embassy sponsor has undertaken to offer a number of high-quality projects to us. We're not obliged to take those. There's a mechanism under SEBI regs for valuation. There's an independent vote on that acquisition and so on. But that could add up to, in the short term, and by that I mean 3 to 5 years, that could add 18 to 20 million square feet. So again, that could bring us up to maybe a 50 million square foot level. And then there's the potential for third-party acquisitions from non-related parties.
One last question. You mentioned, of course, that you have been in conversation with SEBI and they've been very supportive. We've seen the REIT regulations take quite a few important turns to encourage retail investors. The latest thing that SEBI has proposed is to bring down the entry barrier for retail investors down to about 15,000 rupees from 2 lakh rupees currently. That's not been passed yet. Any reason why you didn't want to wait for that to happen? The minimum entry barrier for retail investors that your REIT is offering is about 2,40,000 rupees. Are you worried at all about retail participation, given that it's a slightly high entry barrier for an instrument that retail investors may not fully understand?
Yeah, we're certainly not worried at all. We genuinely believe in the quality of the platform, the product, the REIT, the governance. We've got great interest from international investors. As people see and understand the strength of REIT as a product, we believe that it will, as it has in the States, in Australia, in Europe, that it will be widely accepted by retail investors.
Okay, so that was about Asia's largest REIT. But moving on and shifting focus to a mega CNBC-TV18 exclusive now. Earlier today, we spoke with Morgan Stanley's Rhythm Desai on his market projections along with his top sectoral bets. Now, he is bullish on the real estate sector as well as banks, and also adds that they can look to buy some select NBFCs. Listen in to that exclusive conversation.
We've had a pretty strong stimulus from the government in terms of spending. And therefore government capex, and we have to aggregate both SOE as well as state government and central government capex, not just central government capex. Together these numbers look like they're at all-time highs relative to GDP. So they're compensating for the lack of private capital spending. Also, what has happened notably, which I don't think we should ignore, is that 2 years on, more capacity has got utilized in the private sector. So right now I would estimate, or I should say guesstimate, that utilization rates are in the low 80s. And another 2 years they'll be in the low 90s. Now it's a time at which capacity needs to come on stream. So sometime in the second half this year, post-elections, I think the private sector will start debating capex.
You will not talk stocks, but what caught my attention were 2 or 3 real estate stocks. There was an overrepresentation of real estate in the list of stocks that came in the Morgan Stanley report. And this is coinciding with CLSA also putting up a slightly bullish report on real estate. You think those assets have troughed out and we should look for good stocks in that sector? My
view in January when the elections were looking a little bit fuzzy, the election outcomes, our view was that beyond May, the market will start trading the growth cycle. So May will come and go, and the ballot will fade in importance very quickly. So yeah, I would hold on to that opinion as well. On sectors, I think if I were to characterize this in one line, I think you want to buy domestic cyclicals, both consumer cyclicals and industrial cyclicals. I think both of them look quite interesting. I think income growth is looking strong, and therefore consumption in the discretionary space should improve, which includes the likes of autos, airlines, it includes hotels, it includes a slew of sectors which are discretionary in nature. And then industrial cyclicals, which includes the host of industrials, engineering companies, construction companies, the big turnkey guys, everyone. So I think these are the 2 places that I would put money to. And then of course financials, where we would buy select non-banking financials. They have rallied, a lot of them have come back 20-25% from their lows in the last month, but they are still well off the tops. And I think a lot of the problems there have settled down. Growth in those companies may look a little bit tepid over the next year or so as they build more liquidity and capital on their balance sheets, but I think it's more or less in the price. And then of course corporate banks. We're going to get very strong earnings from corporate banks. So they are, you've got to have a bid on them all the way through. They will likely get re-rated and will report strong earnings over the next 2-3 years. So that's the space we want to be. On your question on real estate, I am very bullish on real estate, both commercial and resi. Commercial, the cycle probably troughed 2 years ago and is already on its way up. Resi, I think, will likely trough in the next 1 year or so.
India on the cusp of earnings revival, and you can catch the full conversation this evening at 5:30 p.m. only on CNBC TV18. Let's move on and talk about a key issue that's grabbing headlines, and that's about the turbulence around Boeing 737 MAX 8 aircraft. Now, following 2 fatal crashes of the said aircraft, India too grounds the aircraft effective 4 p.m. today. Anu Sharma joins in with more details. Hi Anu, good afternoon. What is likely to transpire in this meeting and who all are expected to attend?
Well, 10 airlines across 7 countries are the only carriers in the world which continue to fly the Boeing 737 MAX aircraft. Over 65% of the global fleet of the MAX planes has been grounded, and now only around 127 of these planes are flying. Over 55% or around 72 of these are originating from the United States through 3 of its airlines: American Airlines, Southwest Airlines and United Airlines. Airlines from Canada, Air Canada and WestJet are operating around 37 MAX planes currently. U.S. aviation regulator, the Federal Aviation Administration, today again said that so far no basis to ground Boeing 737 MAX planes, and their review shows that there has been no systemic performance error. Indian airspace, on the other hand, will be closed for MAX operations effective 1600 IST or 4 p.m. today. A meeting of Indian Airlines, SpiceJet and Jet Airways, the 2 Indian carriers which have the MAX aircraft, is set to take place with the ministry officials to decide the subsequent plan of action. While 5 MAX planes are of Jet Airways, but these are grounded due to non-payment of lease rentals. SpiceJet has 12 of these which are active. Now, SpiceJet has already started the process of grounding these aircraft, and it has said in a statement that by 4 p.m. today, all of these aircraft will be grounded. But then again, it will be important for the airline, as it has 155 MAX planes on order, while Jet Airways has a total order book of 225 MAX planes. So it remains to be seen what kind of compensation are these airlines being provided by Boeing, and how much time does Boeing take to identify the error which has caused 2 fatal accidents in the same aircraft model within a span of under 5 months. Back to you.
Absolutely, Anu. In fact, the banning of the Boeing 737 MAX 8 aircraft remains a developing story, and you can catch the latest by logging on to our website, CNBC-TV18.com. Well, let's shift focus now to a CNBC-TV18 exclusive. Sources tell us that IRDA may take up life insurance product regulations in the upcoming board meet on March 27. Yash now joins us to tell us the detail. Yash, tell us what could be on the agenda in this meeting.
Well, Anisha, as you rightly pointed out, March 27th would be that important day when the Board of Insurance Regulator IRDA would be meeting, and they would be considering some important amendments when it comes to the life insurance regulations. Now, what I've been given to understand is that the board would be considering some of these important regulations both in the linked product space as well as the non-linked product space. And just to take you through some of the important things which might come up post the board meeting, what we're given to understand is that IRDA, after this board meeting and considering the regulations, may allow insurance to charge extra premium, additional premium, when it comes to policyholders who want to buy riders over and above a ULIP policy which they already hold. Of course, these riders can be in various forms, the most common form being any sort of rider which comes with a critical illness cover or a top-up. So yes, extra premium will be allowed to charge to these policyholders. Currently, these insurance companies can only deduct ULIP units equivalent to the value of the rider which they are topping up or they are adding. Essentially, just to give you an example, if let's say a policyholder is buying a policy of 100 rupees where the insurance company is buying 10 units of ULIP of 10 rupees each, right now if he buys additional top-up of 20 rupees, 2 units of ULIP get deducted, but now that 20 rupees would be able to would be charged extra by the insurance companies, essentially not affecting the asset or the investment of the policy holder at all. Apart from that, of course, we are given to understand that insurance regulator may allow insurance companies to do away with minimum capital guarantee when it comes to pension plans. Of course, there is a minimum capital guarantee which is given to policy holders, and to get that capital guarantee, insurance companies invest heavily in debt instruments. This doing away with minimum capital guarantee will allow insurance companies to really play with their investments, to play more into equities, less into debt, and so on and so forth. Apart from that, we are also given to understand that a partial withdrawal of about 25% could be allowed when it comes to the corpus of pension plans. Right now, there is no partial withdrawal allowed, and this partial withdrawal of 25%, according to our sources, could be allowed in exceptional situations, things like illness, marriage, education, so on and so forth. Last but not the least, we are also given to understand that insurers may be allowed to offer minimum sum insured in case of death benefit, which will be 7 times that of the annual premium. That is also likely to be come up. The important day is March 27th. We'll have to wait for that day to understand what out of these points gets approved and what does not.
Okay, so a crucial meeting coming up on March 27th. Yash, we trust you to get us the latest from that. Thank you so much for joining us. But moving on, real estate stocks were in focus today. CNBC-TV18 learns that the GST Law and Fitment Committee has proposed a reversal of the input tax credit by real estate developers on input goods as well as services which are lying unused as of March 31st. Timsi Jaipuria joins in with the exclusive details. Timsi, over to you.
Well, that's right. What we understand from sources as of now is the fact that the agenda is almost set for the upcoming GST Council meeting, and the GST Law and Fitment Committee has proposed that the only way forward for a smooth transition on real estate, that is from old rates to the new lower rationalized rates, is that the ITC on the input of goods and services which is lying unused as on 31st March 2019 should be reversed by real estate developers through their return form, that is GSTR 3B. And government feels that the ITC benefit available to the real estate developers will actually lapse and die over there itself. And from 1st April 2019, any new invoice raised by the builders will have to be charged at 1% for affordable housing, again without ITC, and at 5% without ITC for other than affordable housing. Now remember, the 34th GST Council is all set to meet on March 19 to finalize the transition norms for the reduced rates on real estate. Now meanwhile, the government has also assessed an impact of this change, and this assessment actually is a little worrisome for the home buyers because the cost of affordable housing could go up and the cost of luxury housing could drop once this transition happens. Also, developers might go in for repricing of projects, and it will be tough for the government to track the procurement clause that they have put in, which says that 80% of procurement needs to be done by registered dealers. Also, this entire scheme of things might result in a sudden increase of anti-profiteering complaints. So it's a mixed bag that government will have to take a tough call on in the upcoming GST Council meeting. We'll keep you posted.
Okay, so an upcoming meeting on March 19th as far as the GST Council is concerned.